It's a pleasure and honor being here, and thank you, Rajesh and WMG, for inviting me over. I am reminded of what George Soros said. He said, Good investing is boring. If you are having fun investing, you are probably making less money." So, let me share with you some very boring thoughts. Any business grows in two ways. One is through volume growth, which we call the real growth, and if prices go up, that and if you add the two, the price increase and the volume growth, it becomes the growth of that business in rupee terms. Similarly, we are looking at India's economy here. So the last 4.5 decades, what has been the performance of India's economy is summarized here. The blue bars give you the decadal average annual growth rate. The blue bar is the real growth, the volume growth, and the orange bars on top is the average annual inflation of the decade. And all these events have taken place in these 45 years. So this is a remarkable picture because you plot this in, I don't think it would be true in any other country. You would see the economy is getting impacted a lot more by what happens around the world. But in India's case, you can see through all these events, India has grown roughly 6% a year in real terms for 45 years. And inflation that used to be about 9-10% until 2000 has come lower because we have opened up the economy to internal and external competition. Today there is no more licensing. You can set up whatever business, you can produce as much, you can sell as much as you want to, you can import freely, and competition continues to increase. And so because of this reforms of opening up the economy which have opened up the supply side over last 3 decades, inflation in India has structurally moved lower, and currently inflation is running around 4% a year. So the obvious question is that what makes India tick? What makes India grow? People worry about tariffs. I don't worry about tariffs because I don't think it will impact India at all. But I'll come to that maybe in few minutes. So what has delivered this 6 to 7% growth in India through all these disturbing headlines and through so many challenges, irritants that we face and that we complain about in India virtually every single day? So the 5-6 drivers of growth in India have been: one, our population continues to grow. It poses other challenges, but for the economy it's an asset. And this population is growing today when most other economies in the world are having a negative growth in working age population. Even China's population has peaked. Europe has been degrowing for a long time. Japan has been degrowing. So our population continues to grow. So that drives about 1 to 1.5% of growth every year. You consume more the moment you break up a joint family into a nuclear family or multiple nuclear families, because a family needs a home. You need all the consumer durables, everything that goes with the home. So joint family in India is also breaking up slowly. In China, 25% of families are one-member families. So that's the direction the world is moving in. Fortunately, we are still not there, maybe 5 decades down the line. So the number of families in India continue to grow, I think around 2.5-3% a year. So a large part of the growth, 30, 40, 50% of the growth you can explain by the growing population, and the way we are living is changing. The third thing that drives growth in India, these things are relevant even for maybe an African country or a Pakistan or a Bangladesh also. They also have very young populations, but the growth rates are low. So what makes India tick again is the remarkable socio-economic political stability that we have. Elections are fought vigorously, but the transition of power is very smooth. So that is very remarkable. Not many countries in the world have that. So there are no serious internal discords in India, like is happening in many countries of the world. Two warring factions, they kill each other, destroy the country. So we are by and large a law-abiding, peaceful society, and it offers a great deal of social and political stability, which is essential for growth. The fourth thing what is good about India is that it is extremely rich in human and natural resources. So not all countries in the world can boast of such talented people what we saw here, and these are there in lakhs and millions in this country. We have millions of smart individuals, entrepreneurs, doctors, lawyers in every field that you can think of. I think we have the capability to excel. We are rich in natural resources. We are 2.5% of world's area, 18% of population, yet we export agricultural produce. Why? Because India is incredibly fertile. The weather is very good. You get sunshine 365 days a year. Every few hundred kilometers you would have a river. We have mostly all the minerals but for oil and gas, which also in 10 years time I think will get replaced by solar energy. As battery storage becomes cheaper, you will have EVs, and EVs will run on electricity generated either by coal or by sun. So I think in 10 years time, even the lack of fossil fuel which we import will be felt to a much lesser extent, and that if that happens one day, I think India will be incredibly strong, because then finally you will have a current account surplus. You will earn more dollars than what you need, and that is when you can look to not a depreciating but an appreciating currency. I think we are moving in that direction, but that probably is another 5-10 years away. So that was the fourth thing what makes India tick: the human and natural resources. And finally, I think how long can this growth sustain? So let me ask you a question. Do any of you know how many families in India own a car? Any guesses? About 12%. It used to be 8 few years back. How many families in India have air conditioning? About 7. How many people, what percentage of Indians fly once a year? About 2 to 3%. So these very simple numbers tell you that as income grows in India, demand is not a challenge. You go to Japan, you give them more money, there's more cars cannot be sold. The only demand in Japan is replacement demand. So there is nothing you can do about some of these economies. So India is not just a young country, it is not just a growing country, but it is, while being a very large economy, it is still a very low income country. So we are the world's fourth largest economy, soon to become the third largest. But in per capita income terms, India is a very low income country. I won't call it a poor country. About 2 out of 3 families in India earn probably less than 30 to 40,000 rupees a month. So that is the level of penetration of consumer discretionary goods and services, and that's why I think one can be optimistic on India for many, not just years, but for many decades. Let me share with you some more very interesting slides. So this top left hand side chart, it presents to you the working age population across major economies of the world, how it is changing. India is the only major economy where the number of working age people will continue to grow for the next 30 years at least. And that is opening up a huge opportunity. Post COVID, remote working has gained acceptance tremendously. So when employees are working from home in London or New York, the chief executives felt, why not shift this job to Chennai or Bangalore or Hyderabad? And see what has happened on the right hand side. The number of global capability centers, which are essentially remote offices of these global multinationals, continue to go up. And the orange line, which is the net exports of other business services, excluding software, which used to be zero in 2020, was last year close to 35 billion US dollars. So this GCCs or other business service exports has emerged as a key driver of growth in India. It is creating large number of jobs in India on one hand, and it is also reducing our current account deficit very sharply. So if you look at this chart in the middle, the CAD to GDP, CAD is current account deficit. It is basically the gap, the shortfall between exports and imports. And this used to be India's bane. It used to be our weakness. So we used to run a very high CAD of 2 to 3% of GDP. Now imagine your economy is worth $100. You are importing goods worth 10, exporting worth 7. Where does the $3 come from? So $3 was coming from essentially borrowing. You go to the world market and borrow $3, or you ask them to buy some of your companies or to invest in this economy. So any country which remains a current account deficit country will continue to become more and more indebted. So it is not a very sustainable thing, not a very good thing. So fortunately in India now, our current account deficit has come down to extremely low levels. It's just about 0.5% now. And I think this number will not go up again. So what is changing? One, we have already discussed that export of services through remote working is growing up sharply, and it should continue to scale up. Even last year it grew 15%. The second thing what is driving this is that a very large number of Indian students have gone abroad last 10-15 years and continue to go abroad. Now they are beginning to work and they remit some money back. So last year India's remittances were about 125 billion US compared to 75 billion US 5 years back. So our remittances have been growing extremely strongly. US today is the largest source of inward remittances into India, unlike Gulf many years back. So Gulf, lot of blue collared Indians used to go there and remit money. Now it is white collar Indians who are going to Europe, to US, and they are remitting money, and this trend should again sustain for a long time. So I think India's current account deficit is extremely low now, and that is a good strength for this country. Just two more charts and then I'll move on to what's our view on the markets. The top two charts present to you how the decadal inflation in India has moved lower every decade. So we used to be a supply constrained economy. When I was in school, I remember cement, kerosene, LPG gas, telephone connection, scooter were in short supply. You had to wait for many years to get hold of one. It is unbelievable, but that was the time. You would get something like 2 lakh priority number for a Bajaj Chetak, and your number will come after 10 years. So you can see how things have changed in last 3 decades. Inflation, which used to be 9-10%, is now running at 4%. On the top right hand side is a very remarkable chart. This is the difference between India and US 10-year yields, or basically India and US interest rates. So you can see how a 5 to 6% gap has come down to below 2%. So the cost of borrowing in India is now just 2% more than in the US. And that in other ways is telling you that the currency depreciation should be just about 2%. Whatever is the gap in interest rates in two countries, that is the market's expected depreciation of the currency. So the currency depreciation going forward should be a lot less. The lesser a country's currency depreciates, or on the other side, if it appreciates, the more will be the prosperity, because depreciating currency continues to increase cost of living. On the bottom here you can see India's fiscal deficit, how the fiscal deficit continues to move lower steadily every year. So in summary, India's economy has grown with a high degree of stability for reasons I already explained to you. I think the external situation of India is one of the best that we have seen. I have shared with you some thoughts around that. and I look to the next 10-20 years with great optimism and confidence, and we think India's economy should continue to grow between 6 to 7% a year for many years to come. India is the world's fourth largest economy now. In 2 to 3 years time, it should be the world's third largest economy, and it will remain the fastest growing economy for maybe a decade or two amongst the top 20-30 economies of the world. Let me now share with you a very interesting slide. This slide gives you the journey of Sensex. What is Sensex? It is the barometer of stock prices. You can say it's the country's average share price. So the column, Sensex column, gives you the value of Sensex as on 31st March of each year from 1979 every year. So 100 has become 80,000 in 46 years. That is the journey of Sensex. Let me make it very simple for you, how this has been possible. So may I request you to start with 100 rupees or $100 and double it 9 times. Please double 100 9 times and see what do you get. Yes, anyone? How much? 51,200. If you double 100 9 times, you will get 51,200. If you double it 10 times, you will go to 1,02,000. The Sensex is at 80,000. So that tells you that the Sensex has doubled between 9 and 10 times in the last 46 years. Yes? Which means it has doubled every 4.5 to 5 years. If you divide 100 by 10, it is 4.5. If you divide it by 9, it is 5. So the question is very simple. Why has the Sensex doubled every 4.5 to 5 years? Why not 8 to 10 years? Why not 2 to 3 years? The answer is again very simple, and we had discussed this slide earlier. What is the Sensex? It represents a diverse portfolio of businesses. And what is the economy? It is the sum total of the same businesses. The shares, a business value grows directly as much as the value of the underlying business grows. The value, the share price, the market cap will grow as much as the business grows. If you add up all the businesses in the country, it is the economy. So what was the economy growing at till 2000? It was growing at 15% a year. 6% real growth, 9% inflation. Last 25 years, it has grown closer to 13% odd. If you grow something at 15%, it will double in 4.5 years. If you grow it at 14%, it will double roughly in 5 years. So the simple message is that Sensex has grown every 4.5 to 5 years simply because the economy, which is nothing but the sum total of businesses in the country, has doubled every 4.5 to 5 years. So if you look at the Sensex year to year, you will not make any sense out of it. So the 1 year column gives you the returns of the Sensex over every 1 year. What do you see there? It's a random movement. There is no trend, there is no pattern. That is why equities are called risky. I prefer the word volatile. Risky is something when you lose something. But in equities, you don't lose, it just fluctuates. So while no one can forecast 1 year returns in equities, as the 1 year column tells you, and that's why you must invest with 3-5 years at a 10-year view. But if you look at longer term returns, you will find the risk in equities goes down considerably. This table gives you the same numbers but now over 5-year periods. And if you look at how Sensex has moved every 5 years, you will find you have not lost money on the Sensex. I am not here to sell equities, but let me just present to you why you must do your asset allocation very thoughtfully. So If you put 100 rupees in a bank and you did not pay any taxes, which you have to in reality, but even assuming no taxes, that 100 becomes 3400 over 46 years at an 8% assumed rate. In Sensex, it has become 77,000. So this is the power of compounding. If you grow something at 16% and if you grow something at 8%, it makes a difference of 22 times to your wealth over long periods. I am sure you understand all of this, but as I said, equities is very boring. But what therefore equities need is not deep intelligence, but they need deep patience. For 100 to become 80,000, what did you have to do? You had to do nothing. If you did something, you earned less. That's the fact. The more times you did something, the lesser were your returns. So equities are a stock market is a device to transfer money from the impatient to the patient. That is the key to equities. Equities need more emotional quotient than intelligence quotient. So equities is about patience, it is about discipline. So I think India is a very good story. Be patient with India. It will continue to grow your wealth, it will continue to compound your wealth. But just one modification here. Today you are a low inflation country. When most of you must have taken home loans, you would have paid 12-14% interest rates, right? But today you will get a home loan at 7.5 to 8%. Why? Because inflation in India is low, interest rates are low. But that low inflation also means that the growth of the economy in rupee terms is lower. If you grow at 6 to 7% in volume terms, you add 4% inflation to that, so that brings you to 11 or 12%. So I feel the Sensex should continue to grow, but it will take about 6.5 years in the future to double. Now, two more things. You may have concerns that is the Sensex very expensive. So look at the 10-year column, the last row. That is 11. So the last 10-year returns of Sensex have been around 11%. So that is not excessive. It is in line with the growth of the economy. For a Sensex to be expensive, the past returns have to be much higher than the economic growth rates, which clearly is not the case here. So that's why I feel these are reasonably valued markets. Markets have been flat for last 1 year. So some excesses that were there have gone. So in the next 3-6 months, I think is a decent time for you to invest in equities, because within 6 months, markets will start trading on calendar 27 or fiscal 28 earnings. Multiples there are looking quite reasonable. Now, last thing on my mind is about these US tariffs. So if India's economy is 100, how much do we export to the US? How much goods do we export to the US out of 100? Anyone? It's 2. So only $2 of goods are exported to the US. And what is the value addition in manufacturing? When we export these mobile phones, what is the value addition here? 20%. When you export gems and jewelries, you import diamonds, rough diamonds, you export finished diamonds. You import crude oil, you export gasoline. So the value addition in India's manufacturing is actually quite low. So even of the 2%, the value addition is probably 1/4. It is 0.5%. So what is going on? I don't think this will impact India's economy at all. What India needs from the West is dollars to fill our current account deficit, which is extremely low. So I think India is on a fairly strong wicket. We should not get impacted by this. Of course, individual companies may get impacted. If you are exporting shirts or trousers and your duty on you is more than Bangladesh, then of course you will lose competitiveness, you will lose margins. But the impact in the overall scheme of things will be extremely small, maybe 0.25% of GDP. So I don't think we need to worry about that. I mean, going by, I am not an expert at all, but what I observe that probably this is the last round of negotiation, because you are expected to do a little more, and in the end, I think in the next 4 weeks, 6 weeks, whatever it takes, I think both India and US have a very good relationship. We need each other, we complement each other. The amount of services that India exports to the US, I don't think there is a replacement to that. It would be very, very difficult. There is no country in the world which has a large English speaking, young, technically qualified, and low cost manpower and a well developed ecosystem of software services over the last 3 decades. So I think India and US both gain from a lot from this relationship. So I think in the next 4-6 weeks, as has happened with many other countries, I think this deal should be negotiated. But even if it takes time, I don't think it is a deal breaker. So thank you very much. I think you will agree in the end this was pretty boring, but it can be profitable, I assure you.
Sure. I think we've got time for just a couple of questions. I have one from my side though. Usually when it comes to the markets, there's a wealth of data for you to be able to look at various scenarios and situations to be able to extrapolate what you could anticipate when it comes to economic bubbles, economic downturns. But in the last 5-6 years, the world is seeing something for which we don't have a precedent. I mean, we don't have a precedent on what would expect. With the US president thinking there is no precedent to be able to gauge where this would go to. When you're acting without information, what is your thought process to be able to think through? I'm not looking for an answer as much as the way you think.
I think, see, if you read papers every day, you will be confused. And that was if you go to this slide, these are the headlines of last 45 years.
Right.
They are extremely disturbing. Headlines are seldom positive. Seldom positive. How many times will you get positive headlines? Because we disregard positive news. Your attention is captured by negative news. So that is, I don't know why, but all of us behave that way. If someone funds the education of 1,000 students, it will come on the inside page, but if there is a crime, it will grab everyone's attention. So that's how we are. So I think this will pass. As I explained to you, India is a really very, very resilient economy. Maybe I can show this one more slide to you. So look at this bottom chart. This is the volatility of GDP growths of various countries. India's volatility is by far the lowest. By far the lowest. Why? Because we are primarily consumption driven and we are exporters of services and not goods. And service exports are less volatile than export of goods. So I think to be a good investor, you need to cut through the noise, not react to headlines. Please analyze what impact this headline will have on us. And that's why I broke up the impact of this tariff war on what potentially it could impact us. I don't think it is going to impact. India, by the way, grew 5.5% even in the year of Lehman crisis. So it is unbelievable, but this is correct. So that tells you how resilient this economy is. Instead of 6, we may grow at 5.5. That is some volatility always. But otherwise, I think we are pretty safe.
One more question. So what's your view on gold and cryptos?
You know the origin of Ramayana? Because Raman crossed his Lakshman Rekha. So I don't want to cross my circle of competence. So I have no understanding of crypto. Gold, I will tell you this much. Gold is a very good insurance. Where gold goes is very hard to say because there are too many forces at work. If US yields move up, it could be adverse. If currencies, why is gold here? Because you impounded Russian reserves. And so large countries in the world want to diversify away from dollar reserves into other currencies or crypto or gold. So I don't know where these are headed. But I think it makes sense to hold 5-10% of your wealth in gold unless you are a billionaire. then it becomes impractical. Why? Because gold is a unique asset. It is a global asset while being in India. I don't think it will ever happen, but if India becomes, something terrible happens to India. If you are in, let's say, a country which is a failed nation, then real estate has failed, collapsed, stock markets have failed. Only gold has maintained your purchasing power. So look at gold as an insurance. If everything else fails you, gold will still hold on to its purchasing power. So buy gold and pray that you don't make money on it. Because you want to buy insurance, but you never want to use it. So buy gold, and if it doesn't do well, it means India is doing extremely well. Yes.
You have been advocating periodic investment or SIP all through for the last 22 years. And how has it really impacted the investment fraternity?
No, I think it is Indian stock markets don't dance to the tunes of foreign managers now. Foreign money, because local flow of capital is so large, it is so large that foreigners can come and sell and markets don't go down. So the volatility of Indian markets has collapsed, and the reason is this. I think India is still in the early stages of equity investing. Only 6% of household assets in India are in equities. Globally, that number is between 20 to 40%. And I think SIPs is it's the best way to invest for two reasons. One, if you want to reduce the volatility, if you invest the same 1,000 rupees in 100 rupees each over 10 months, the volatility of wealth will be a lot lower. So it reduces the volatility of equities. That's reason number one. And reason number two, very important, many of us get monthly paychecks. So if you invest as you earn, it is very natural. So I think SIPs India will continue to grow, and they will continue to lend more stability to equities. I feel Indian stock markets are in a virtuous cycle. So if you go back and see the history of US markets, when 401k started in US in 1980s, means basically out of retirement money you started investing in equities, the flow of money to equities became pretty sustained, regular. Because of that, the volatility fell in US. And when investors make returns with lower volatility, they get the confidence to increase the allocation towards that asset class. So I think India appears to be in that type of a cycle, and over next 3, 5, 10 years, I think the allocation of household savings towards equities will continue to rise. I think SBI mutual fund is touching almost 100 billion of equity assets. So HDFC, Prudential, they must be around 70-80 billion, and they continue to grow 10-15% a year. So today you don't need to worry about the foreign large institutions. The mega institutions, investors in India are in India. So the economy grows, you consume more, we profit from that wealth, and the stock market should be a lot less volatile in the future. And you are seeing that. Calendar 24, second half, foreigners were large sellers. Where did markets fall? So I think future dips in markets will be lot shallower and lot shorter.
What do you think will be the way forward for India when Russia, China, or India comes together? Is it a good idea?
Live in the present. See, तो मेरे गुरुजी कहते हैं भूतकाल एक सपना, भविष्य एक कल्पना और वर्तमान अपना. What it means is, don't live in the dreams of the past, don't imagine the future, be in the present. See, we don't know, it's a very complex world, it's a very transactional world. Who will side with whom? We don't know. Russia has been a steadfast friend of India, we all know that. But now it's a bit complicated. But I think India is a very strong country. It's the only country in the world, and we have Major General Saxena here. So India is the only country in the world which can match boot for boot with China. No one else can do. So I think it's a very strong country. We have an incredibly strong armed forces. We have a very strong economy. China is aging, India is not. I showed you that slide. Look at that chart on the top left. The number of working age people in China is dropping. So I think India is now dealing with other countries. It's not compromising its long-term interests. We are dealing with a position of strength. We are negotiating well. So I think I am not an expert on geopolitics, and I think it is extremely hard to forecast these events. But the outlook for India's economy, I think we should do well, irrespective of whatever equations ultimately are settled. Yeah, thank you. Pleasure.